They did it again. Just when silver was breaking out, just when the momentum was building, just when retail investors and institutions alike were piling into the trade of the decade. The CME group pulled the lever. They raised margin requirements by 18% overnight, without warning, without justification, without any pretense of fairness. And within 24 hours, silver crashed 9.7%. Billions of dollars in wealth evaporated. Thousands of traders were liquidated. The breakout was crushed before it could threaten the system. This was not a coincidence. This was not risk management. This was a coordinated attack on the silver market executed with surgical precision. Welcome to the Market Cipher. I'm here to decode the manipulation they hope you never understand. Let me be absolutely clear about what happened. The CME group, which operates the COMEX futures exchange, announced an 18% increase in silver margin requirements effective immediately. This means traders holding silver futures contracts were suddenly required to post 18% more collateral to maintain their positions. For a trader holding 10 contracts, this might mean coming up with an additional $15,000 overnight. For a fund holding hundreds of contracts, we're talking millions of dollars in sudden margin calls. Many traders couldn't meet the call. They were forced to liquidate. They had to sell their positions at whatever price the market offered. This forced selling cascaded through the market, triggering stop losses, creating panic, and driving prices down nearly 10% in a single day. The CME will tell you this was prudent risk management. They will say volatility increased and margins needed to reflect that risk. They will present themselves as responsible stewards of market stability. They are lying, and I'm going to prove it. Let me show you the timeline that reveals the coordination. 3 days before the margin hike, silver closed at a multi-year high. Momentum indicators were screaming bullish. Technical analysts across the industry were calling for a breakout to $35, $40 or higher. Social media was buzzing with silver content. Search interest for silver investment hit a 6-month peak. The bullish case was becoming impossible to ignore. Industrial demand from solar panels was accelerating. Supply deficits were confirmed by multiple industry reports. COMEX registered inventory was draining toward historic lows. The setup was perfect. Then the CME acted, not during normal business hours, not with advance notice. They announced the margin increase after the market closed, effective the next trading session. Traders went to bed holding positions they could afford. They woke up to margin calls they couldn't meet. They had hours to deposit funds or face liquidation. Most couldn't wire money fast enough. The timing was designed to maximize damage. The timing was designed to catch traders defenseless. The timing was designed to break the rally. And it worked. Silver opened down 4% the next morning and continued falling throughout the session. By the close, the damage was 9.7%. Weeks of gains wiped out in hours. Now let me explain why this pattern keeps repeating. This was not the first time the CME has weaponized margin requirements against silver. It's not even the 10th time. This tactic has been deployed repeatedly throughout history at precisely the moments when silver threatens to break free from suppression. In May 2011, silver was approaching $50 per ounce. It had risen over 150% in less than a year. The momentum was unstoppable. Retail investors were flooding into the market. The bullion banks were bleeding on their short positions. Then the CME raised margins 5 times in 8 days. 5 times. Each increase forced another wave of liquidations. Silver crashed from $49 to $34 in 2 weeks. It would take over a decade to approach those levels again. In January 2021, during the Wall Street bet silver squeeze, the same playbook emerged. As retail traders coordinated buying and silver spiked toward $30, the CME hiked margins. The squeeze was broken. Prices retreated. The narrative shifted from silver shortage to silver abundance almost overnight. And now in 2024, as silver again threatens to break out, as the supply situation has become genuinely critical, as industrial demand overwhelms mining supply, the CME deploys the same weapon. The pattern is undeniable. Every major silver rally is met with margin increases designed to liquidate long positions and crush momentum. This is not risk management. This is market manipulation institutionalized. Let me explain the mechanics of how margin hikes crush prices. Futures markets operate on leverage. A trader might control $100,000 worth of silver with only $10,000 in margin. This leverage amplifies both gains and losses. It also creates vulnerability to margin manipulation. When the exchange raises margin requirements, traders must immediately post additional funds. If they can't, their positions are liquidated. The exchange doesn't wait. The broker doesn't negotiate. The position is sold at market price. Now imagine this happening to thousands of traders simultaneously. Imagine the selling pressure when everyone must liquidate at once. Imagine what happens to price when there are thousands of forced sellers and few willing buyers. The price collapses, not because fundamentals changed, not because silver became less valuable overnight, but because the exchange engineered a cascade of forced selling. This is the weapon. This is how they control the market. This is how they've suppressed silver prices for decades. And the most insidious part? It's completely legal. The CME has broad discretion to adjust margin requirements. They can cite volatility concerns. They can claim they're protecting market integrity. There's no regulatory barrier to this manipulation. The foxes don't just guard the henhouse, they built the henhouse. They wrote the rules, and they adjust those rules whenever the hens start escaping. Now let me show you how the timing proves coordination. If margin increases were genuinely about risk management, they would be implemented gradually. They would be announced with advance notice. They would be proportional to actual volatility changes. Instead, we see emergency hikes announced after hours, effective immediately, sized to maximize liquidation pressure. The timing consistently coincides with bullish breakouts rather than bearish collapses. Think about this asymmetry. When silver crashes, does the CME emergency hike margins to prevent excessive losses for short sellers? No, they let prices fall as far as the market takes them. When silver rises, they intervene aggressively. They don't cite margin concerns when banks are profiting from falling prices. They only discover risk management when banks are losing money on rising prices. This asymmetry is the fingerprint of manipulation. A neutral exchange would manage risk symmetrically. A captured exchange protects its member banks at the expense of outside traders. The CME is a captured exchange. Its member banks hold massive short positions. When silver rises, they lose money. When silver is crushed through margin manipulation, they profit. Follow the money. It always reveals the truth. Now let me explain who benefits from this manipulation. The Commitment of Traders report shows that commercial traders, primarily large banks, consistently hold net short positions in silver futures. These aren't hedging positions for physical inventory. These are speculative bets that silver prices will fall. When the CME raises margins and crashes the price, these short positions become profitable. The banks buy back their shorts at lower prices. They pocket the difference. They reload short positions for the next cycle. The traders who get liquidated are primarily retail speculators and smaller funds. They don't have the capital reserves to meet sudden margin calls. They don't have the political connections to know when hikes are coming. They're the sacrificial lambs. Wealth transfers from weak hands to strong hands, from outsiders to insiders, from those who don't understand the game to those who rig the game. This is the real function of futures market margin manipulation. It's not about stability, it's about wealth extraction. Now let me address what makes this particular margin hike especially egregious. The 18% increase was implemented during a period when silver volatility, while elevated, was not historically extreme. We've seen higher volatility periods without emergency margin hikes. We've seen more violent price swings without overnight rule changes. What was different this time was the direction. Silver was rising. Silver was threatening to break out of a multi-year consolidation. Silver was attracting mainstream attention for the first time since 2021. The fundamentals justified higher prices. Supply deficits are running over 200 million ounces annually. Industrial demand from photovoltaics is exploding. COMEX registered inventory has fallen below 90 million ounces. The physical market is genuinely tight. A free market would price this tightness. A free market would let silver rise until supply and demand balanced. A free market would reward those who correctly identified the fundamentals. But we don't have a free market. We have a managed market, a manipulated market, a market where exchanges intervene to protect incumbent short sellers from the consequences of their positions. The 18% margin hike was not about volatility. It was about preventing price discovery. It was about protecting bank balance sheets. It was about maintaining the suppression scheme for another cycle. Now let me explain the broader pattern this fits into. Silver price suppression is not a conspiracy theory. It's a documented reality with a decades-long paper trail. The mechanisms have been exposed in court cases, regulatory settlements, and whistleblower testimonies. In 2020, JP Morgan paid nearly $1 billion to settle charges of precious metals market manipulation. Traders were criminally charged for spoofing and other manipulation techniques. The Department of Justice described a scheme spanning years and involving thousands of illegal trades. This settlement proved what silver analysts had argued for decades. The banks were actively manipulating precious metals prices. They were using their market power to move prices for profit. They were doing so systematically and deliberately. But here's what most people miss. The settlement covered spoofing, which is illegal. It didn't cover margin manipulation, which is legal. The banks simply shifted from illegal manipulation techniques to legal ones. Margin hikes accomplish the same goal as spoofing. They crash prices, they liquidate long positions, they protect short sellers, but they're implemented by the exchange rather than individual traders, so they carry no legal liability. The manipulation didn't end. It evolved. It became institutionalized. It became untouchable. Now let me show you the evidence of coordination between banks and exchanges. The CME Group is not a neutral party. Its member banks, the same banks holding massive silver short positions, have significant influence over exchange policies. They sit on advisory committees. They provide liquidity that the exchange depends on. They have direct communication channels with exchange leadership. When a margin hike is being considered, who do you think gets advance notice? The retail trader in Ohio or the bank trading desk in New York? The information asymmetries is staggering. Insiders know when rule changes are coming. They can position accordingly. They can reduce exposure before the announcement. They can even add to positions that will profit from the chaos. Meanwhile, retail traders learn about margin hikes from news alerts after the market closes. They have no time to prepare. They have no advance warning. They're sitting ducks. This information asymmetry transforms margin hikes from risk management tools into wealth extraction mechanisms. Those with information profit. Those without information are liquidated. The game is rigged, and the margin hike is one of the most effective rigging mechanisms available. Now let me explain what this means for the physical market. Every paper market crash creates a buying opportunity in the physical market. When futures prices collapse 10%, dealers don't immediately adjust their physical prices. A gap opens between paper and physical valuations. Smart money uses these crashes to accumulate physical metal at artificially suppressed prices. They understand that paper manipulation doesn't change physical fundamentals. They understand that each crash is a gift from the manipulators. The 9.7% crash following the margin hike created exactly this opportunity. Physical premiums actually increased during the paper price decline. Dealers raised premiums because physical demand remained strong while supply remained tight. This divergence reveals the truth. Paper prices are manipulated. Physical prices reflect reality, and the gap between them continues to widen with each manipulation event. Eventually, this divergence becomes unsustainable. The paper market loses credibility. Physical markets establish independent pricing. The suppression scheme collapses under the weight of its own contradictions. We may be approaching that point. Each margin hike manipulation works less effectively than the last. Recovery times are shortening. The bounces are more aggressive. The fundamental demand is more persistent. The manipulators are fighting a losing battle. They can win individual skirmishes through margin hikes, but they're losing the war against physical scarcity. Now let me discuss what should happen versus what will happen. In a just world, regulators would investigate this margin hike. They would examine the timing. They would question why emergency measures were necessary when volatility wasn't historically extreme. They would probe whether member banks received advance notice. They would find coordination. They would find information asymmetry. They would find a pattern of margin manipulation that consistently benefits incumbent short sellers at the expense of outside traders. But we don't live in a just world. We live in a world where regulators are captured by the industries they regulate, where enforcement actions are settlements that cost less than manipulation profits, where the revolving door between banks and regulators ensures institutional protection. The CFTC will not investigate this margin hike. The SEC will not examine the coordination. Congress will not hold hearings. The financial media will not probe the timing. They will accept the CME's risk management narrative. They will report the price crash as market volatility. They will blame retail traders for over-leverage. They will do everything except identify the actual manipulation. This is why understanding the game matters. No one is coming to save you. No regulator will protect you. No exchange will treat you fairly. You must protect yourself. You must understand how the manipulation works. You must position accordingly. Now let me explain how to position for this environment. First, reduce reliance on leveraged paper products. Futures contracts are weapons that can be turned against you through margin manipulation. If you trade futures, maintain excess margin far beyond minimum requirements. Assume margin hikes will come at the worst possible time. Second, accumulate physical metal during paper crashes. When the CME engineers a 10% crash, view it as a sale. Transfer wealth from paper abstractions to physical reality. Remove metal from the manipulated system. Third, understand that volatility is intentional. The wild swings in silver aren't natural market behavior. They're engineered to shake out weak hands. If you understand this, you can maintain conviction through the manipulation. Fourth, extend your time horizon. Paper manipulators can control daily and weekly price action. They cannot control multi-year trends. The fundamental supply deficit will eventually overwhelm their intervention capacity. Fifth, diversify holding structures. Don't hold all your silver in one form. Physical metal, allocated storage, mining equities, and carefully selected ETFs all have different vulnerability profiles. Diversification protects against any single attack vector. The margin hike was designed to make you sell. It was designed to shake your conviction. It was designed to transfer your wealth to insiders. Don't let them win. Now let me explain why this manipulation is ultimately self-defeating. Every margin hike that crashes prices accelerates physical accumulation by smart money. Every forced liquidation of paper longs creates supply for physical buyers. Every manipulation event drains more metal from the system. The banks are trading short-term profits for long-term catastrophe. They're protecting their positions today while making the supply situation worse tomorrow. They're winning battles while losing the war. COMEX registered inventory continues falling despite these crashes. Industrial demand continues rising despite price volatility. The physical market continues tightening despite paper market manipulation. At some point, the physical market will refuse to accept paper prices. Dealers will stop selling at spot plus premium. They'll establish their own pricing based on actual availability. The paper market will become an irrelevant sideshow. This is where we're heading. The margin hikes are symptoms of desperation, not strength. The manipulators know the end game is approaching. They're grabbing whatever profits they can before the system resets. The 18% margin hike and the 9.7% crash were painful for those caught in the manipulation. But they were also evidence that the squeeze is working. They wouldn't need to intervene so aggressively if silver wasn't threatening their control. Take the pain as confirmation. The manipulation proves the thesis. Now let me give you the framework for what comes next. Silver will recover from this crash. It always does. The fundamentals haven't changed. The supply deficit remains. The industrial demand continues. The inventory drain persists. Within weeks, prices will stabilize. Within months, the uptrend will resume. The margin hike bought time for the shorts. It didn't solve their problem. But expect more interventions. Each rally that approaches breakout levels will be met with another weapon. Margin hikes, options, expiration manipulation, coordinated selling at key technical levels, negative media narratives. The path higher will not be smooth. It will be contested at every level. The manipulators will fight with every tool they possess. Your job is to understand the game and maintain conviction through the volatility. Your job is to accumulate during the manufactured crashes. Your job is to hold through the manipulation events that shake out weak hands. The destination is certain. Silver is undervalued relative to its fundamentals. The suppression scheme is unsustainable. The physical shortage is real and worsening. Only the path is uncertain. That path includes margin hikes, crashes, and manipulation events like the one we just witnessed. Prepare accordingly, position accordingly, profit accordingly. Let me close with the message the manipulators don't want you to hear. The margin hike was not about protecting you. It was about protecting them. The crash was not about market forces. It was about forced liquidation. The volatility was not natural. It was engineered. You are participating in a rigged game. The rules favor incumbents. The information favors insiders. The interventions favor short sellers. But even rigged games have vulnerabilities. Physical metal cannot be created by margin manipulation. Industrial demand cannot be satisfied by paper contracts. Supply deficits cannot be resolved by exchange rule changes. The rigging works until it doesn't. And we are approaching the point where it doesn't. Every margin hike that crashes paper prices while physical premiums hold reveals the scam. Every recovery that follows manipulation proves the underlying strength. Every ounce that leaves COMEX vaults tightens the noose around the manipulators. They just crashed silver 9.7% through an 18% margin hike. And within months, silver will be higher than it was before the crash. They know this. They're simply extracting what they can while they can. Don't let them extract from you. Understand the game. Survive the manipulation. Hold through the volatility. Accumulate during the crashes. The cipher is clear. The pattern is documented. The manipulation is undeniable. This is the market cipher. They raised margins 18% overnight. Silver crashed 9.7% in 24 hours. It was planned. It was coordinated. It was designed to separate you from your position. Don't let them win. Like and subscribe if you want to continue receiving analysis that exposes the manipulation the mainstream won't touch. Share this video with anyone who was liquidated by this margin hike. Help them understand what actually happened. The war on silver continues. The margin hike was just the latest battle. But the war will be won by those who understand physical scarcity trumps paper manipulation. Position yourself on the winning side. The manipulators have revealed their desperation. Now exploit it.